Alright, happy Halloween everybody. A very scary October finally came to a close with not so bad of an ending these past couple of days. Are we going to be able to continue that the first couple of days in November? I'm going to break down what to expect in the short term and whether or not this is that low point and what some of the things to watch for into next week and beyond. I'm also going to break down one area of the market that led the bounce with a stock that's held up a lot better, that's giving us a renewed breakout. So we're going to take a look at that for our trade idea today. Let's go ahead and get started. Today is Wednesday, October 31st, 2018. This is the Market Outlook from MarketScholars.com. My name is David Settle. Thank you very much for watching tonight. Welcome to those of you watching us for the first time. Subscribe to our YouTube channel. Mouse over our Market Scholars logo right there in the bottom corner of your screen. Click that red subscribe button that pops out. That will give you notifications when these videos are posted. Also, click the thumbs up icon down below the video. That tells me, with one click, you want us to do this video again tomorrow. Really easy way to give us feedback there. Comment even further below on anything that stands out to you. Love to see anything you got out of today or any questions that you have. Join our Daily Market Outlook email list. There's a link popping out in the top right corner of your screen. Click that link to subscribe. Follow me on Twitter for more content like this throughout the day. And join our Market Outlook community that we created on Facebook. Alright, well, let's start off taking a look at the S&P 500 here. A little bit of a shooting star candlestick pattern, which is more significant when it's at the end of a bullish run, right? You're in the bottom of you're still at the bottom, relatively speaking, of a bearish run. So keep that in mind. You could almost call it an inverted hammer, though it's not at the bottom. Still a rally today. You can see 29 points closing near the low of the day. That's why the candle looks like it does, a little bit of a long upper shadow. This is not the first long upper shadow. Look, you can see over the past few weeks, just like we've had 4 or 5 days with moves well off the lows. Well, we had 1, 2, 3 days, 4 days, the 1, 2, 3, 4 of the past 5 days where we've come off the highs. So it's it's a battle between the bulls and the bears right now. The intermediate line is rising, not above 20 yet, so still got a strong bearish posture, but we've seen it. We've seen what happens in the past in previous videos when it does rise up above 20, make its way towards 80. You can see the near-term line got above 50. It was above 80 earlier this morning. We were at the highs. Is finished below 80. So not yet as bullish as it can be. When it gets above 80, then we got a sign, a good sign. Now remember, as I've shown you before, when it gets above, like this one right here, when it gets above 80, coming out of this lower reversal zone, it does not typically spend the 7 to 12 days normal move up above 50. Usually it will come back down like it did here. Here it came back down, and didn't come down to lower lows, and that's where the divergence came in. But it did come back down pretty quickly, and usually takes 3 to 5 days for it to get back below 50. So yeah, we're bullish. We're heading towards that divergence target above 2,800. But it's not going to get there in 2 or 3 up days. It's going to be a near-term pullback, most likely in between, before you make that run up to 2,800. And while that intermediate line runs higher, the question is going to be, when it does pull back, does it drop below 20, at least significantly below 20, and does it stay below 50 for more than 1 to 3 days? Because that's typical for the pullback, right? If it here it stayed longer, and that's why we're so bearish. We went to lower lows. And where will we be compared to this low point? Most likely, we'll end up forming a higher low point, somewhere between 2,650 and 2,700. So we'll see. We'll see how that ends up playing out over the next little bit. But don't, if you are bullish, you're expecting this to turn around, don't expect it to all happen in just a few days. It's going to be some volatility. And again, the typical pattern for the near-term line, when the intermediate line's coming out of the reversal zone, is for it to get above 50, get above 80, when it gets above 80, to not stay up above in the upper half of the chart for the typical 7 to 12 days. Watch for it to pull back after about 3 days, 3 or 4 or 5 days. You can see the Dow Jones Industrial Average, same pickup, same long upper shadow. Its near-term line did dip its toe, and its intermediate line is a little bit above 20. You look at the NASDAQ Composite, very similar to the S&P 500. A lot of these stocks are the one that led the rally today. You'll see here in a minute. And then finally the Russell, which has been lagging it's still strongly, bearish, and the near-term line not quite up above 80 yet. Same pattern. But the nice thing is, near-term line is getting above these highs. You look at the NASDAQ getting above the past few days high. Same thing with the Dow Jones Industrial Average and the S&P 500. So the fact that you close up above, especially this day, Monday was the day, right? The day where we hit that new lower low, where at the lowest point at the end of the day, nobody wanted to touch stocks. The market got very one-sided. What's produced as of right now, the long lower shadow on the weekly chart, you'll see, that was the day. And the fact that we still, despite the pullback today, closed above Monday's high, that on that particular day is a good sign. Now, that doesn't mean we'll stay above it, but it does mean that low point on Monday is a good solid support. Already was anyway, because 2600. But in that area, 2600, there's some strong, solid support there. And it's a good sign for a reversal that we close up above those highs on all of these indexes. All right, before we look at some other charts here, just a reminder that as you're watching our video here on the blog, there's links to do other things here. Remember, here's our calendar. In fact, the Strategy Lab class from Brandon, our premium, one of our premium classes, is currently going right now. But if you want to participate and chat about tonight's market outlook with other market scholars, you can do that right here in the Market Outlook forum. Just click that link. If you're not subscribed to our site, you can do that for free by clicking this link up here at the top. Scroll down to the bottom, click this heart right here. That will open up this window, and then hit that like button. That tells us that you want us to do this video again tomorrow. One quick way to give us feedback. You can also do this. Click this icon. Takes you to your Facebook page, and then click the like button there. Again, that one click tells us you want us to keep doing this video tomorrow. Again, 2 really easy clicks. The third one right here is on our blog. You click those 3 things. Again, we get about 1,000 views. We're getting right around 100 of those clicks. So the more clicks we see the more we see that you want us to keep going with these. Alright, when you look at the weekly chart, you can see that long lower shadow that I mentioned. And we needed that long lower shadow on a weekly chart to have the reversal, right? To a lower low that nobody wants to buy, except for the people who did end up buying. And there wasn't a lot of retail investors because the sentiment was extremely bearish Monday afternoon. But somebody's been buying off of that lows, off of more than 100 points off of that low point that we had on Monday. And that's produced that long lower shadow. And as of right now, producing somewhat of a hammer and harami pattern here on the weekly chart, of course. We're not quite above that 200-day moving average. We have two days the rest of this week to see if we end up finishing this week up above that key level. You can see the Dow Jones Industrial Average is above its 200. The NASDAQ's close as well, much longer lower shadow there. And then finally the Russell 2000 well below its 200-day moving average, and we'll see how things change with it being the most bearish of all the indexes. Look at the 3 green arrow chart. You got 2 green arrows. Usually that stochastics is first, but if I break this down, what's another one of the positive signs? Excuse me, not this one. When you break down the lines, you can see the MACD has crossed over its moving average, and so has the stochastic. And it's rising up above that 20. Very, very good signs again. Now again, that MACD, when it rises up from the low levels to 0, it usually does so quickly. When it falls down from high levels, it usually takes a while. When it rises from low levels, it gets up there quickly. You can see, even with the pullback, we finished today above the 8-day moving average, which is the first time we've done that in a while. Look for the 17-day to be the next test of short-term resistance. Getting above that, you have a gap now before you get to the 30-day, which will be the next layer. And then at that, most likely by then, the 8-day will be testing the 17 itself will be testing the 17-day, which means this blue line has gotten back to 0. When that blue line crosses 0, then the 8-day is crossing the 17. The green is crossing above the red up here at the top. And the stochastics, again, similar to the intermediate line, showing a weak bullish posture, means the bulls have control, but very, very weak control. Okay, now let's look at the intraday chart. Remember, the intraday chart, just a kind of a reminder, this pullback on Monday got us down to a 10% weekly range, 4-week range. of the high point. In other words, it's one thing for the market to fall 10% in the correction mode. It's another thing for it to do it within a 4-week range, right? And that's what this is. When the 4-week range gets to 10% of the high, that means the stocks, the market in this case, has fallen 10% in less than 4 weeks. That's extreme. That's a big time move in a very short amount of time. Doesn't happen too often. And you can see that's what happened on Monday, again at that low point. Very, very extreme low there. You can see the gap. You can see the gap up above. This would be Monday, so that's the day, right? That's the change in sentiment day. It was Monday. We gapped up above the high point of that day. We tested it now twice by the end of the day. So now the question is going to be, are we going to hold that and bounce up towards the purple line, which is the open of this week's Hakunashi candle on the weekly chart? Remember, get above that and you start getting long upper shadows on the Hakunashi candles, which would be a good sign again for reversal. And then the dotted blue line is the halfway mark of the 4-week range. So getting up above that dotted blue line means now we're in the upper half of the chart, which happens to be where last week's high was. So you've got a confluence of lines here that are going to act as some resistance in the short term. All three of these can act as a resistance, but breaking up through that, will be that reversal sign, will be a very positive sign. So don't be surprised if we don't move a little bit higher towards this area before we run out of gas again and kind of stall out there. All right, if you take a look now at the volume today, you notice 128 million. One of the only days of this whole run that we've been below average. So this line, this gray line, really the only other day that we had a below average volume day was right there on the 22nd, which happened to be a Monday as well, my wife's birthday. Right after the options expiration, we had a big dip in volume, but then we rose back up. Well, this isn't an abnormal dip. This is a little bit more progressive as it's been dropping here. The volume has been after, you can see kind of what happens, how volume will exceed, and then it will start to kind of taper off. And again, exceed, and then it tapers off, and then it stays below. And that starts to bring the volume down. So if we're going to start tapering off and stay below, then you'll start to see that volume start to taper down a little bit. And again, the range today was what? And you have to add the gap. So if I were to go, the high yesterday was 268.12. The close was 267.77. The low today was 270.12. So you're looking at about 2.25 points. Add that to today's range, which was 311. So you're looking at about 5.5 point range. 5.5 point range on 128 million shares traded. 5.5 point range in context is still a little bit, it's not as high as it's been the last couple of days, but still a pretty decent range. The volume 128 million, so that's about right in this area, a little bit below that average. And again, 5 points is, more than 2%. You can see it's rare for the relative ATR to get more than 2%. I think I've shown you this before. So here's the 2% mark on that relative ATR. You can see earlier this year we got close, and 15 and 16 when we had death crosses, we were also just a smidgen above 2%. You have to go back before that. So here is August of 2011. Remember, we had the death cross there too. We had the credit downgrade. That kind of shows, that hit 3%. That kind of shows how volatile that period of time was relative to where we are now. See, we're not even at 3%, and in August 2011, the ATR to price was at 3% of the price. So that was a big move, relatively speaking, relative to the average ranges of the time. And we were really, really tightening up there on the ATR. And then you can see too, right before QE2 was announced, we hit about 2.5%. So I mean, this sparked QE2. This sparked QE Operation Twist initially, and then eventually QE3, right? That's what sparked QE3 there. And then of course, these all occurred in the bear market, right? So the stock market peaked in October of 2000, right there is where the stock market peaked. So we had a big sell-off right before in August. Then the stock market peaked there. Then we had this is the breakdown to a new lower low in January of '08, and of course you can see this is the financial crisis, and there you can kind of see how extreme it was. 7 to 8%. The ATR got to 7 to 8% of the price of the index, price of this case the ETF. Very, very, very extreme ranges there. Prior to that was the other bear market. So these are all above 2%. These are all bear markets. Prior to that, you can see some peaks around 2% while we were in the bull market, similar to now, and then exceeding that and getting up to 3% was the peak during these bear market runs before we fell off a cliff. So you remember how I mentioned before, I might have mentioned now, I kind of forget what I tell you in our technical analysis class and our Q&As, but usually we are in bear markets for a while before we fall off out of the bed and fall off a cliff. So the bear market, we peaked over here in September of 2000 on the S&P, and then we started to drop for a while, and then you can see the ATR got up to 4%. We fell off a cliff. Well, same thing in '07, '08. The market peaked right there, and then we had some bearishness for a while before not only did it hit 4%, it hit 8%. So it really fell off the cliff there. That we're not going to fall off a cliff. You can see we're not even getting to 3% here, which is where you get to when you have new bear markets, right? That's the peak in bear markets. We're just still peaking at 2%, which is the peak in volatility of bull markets. So don't get wrapped up in the absolute size of the declines simply because the numbers that we're at are higher than where we've been. Yes, it's a big, sharp drop, but on an average basis, relative to the price, it's not, the ATR is not any higher than it got in February or in April, and then initially in June and February, and then again in April when we hit that low point, or when we had the death crosses in the end of September of 15 or end of 2015, beginning of 2016. Even there you can see this wasn't the start of a bear market because we weren't hitting 3%. It's when you hit the 3%, that's when you say, okay, now we're starting more of a bear market. I'm not saying bear market defined as 20% drop from the high. I'm talking bear market where we're getting, extended period of times with pink shading on this chart, right? That wasn't a bear market, according to the ATR, relative ATR, but these were bear markets, right? These, when you get the more extended period of times with the pink shading, these are bear markets. And these were times that, in the initial parts of it, the jumps in volatility got above 3%. These, we only got to 2%, right? This was a 3%, so that could have started one. Same here. That one, these two, but we had QE to help stave off any bear markets there. This was not one, according to the ATR, and this is not one either. Yet, at least, according to the ATR. Finally, look at the volatility here, and remember, volatility above 20 still means you're going to get big ups and downs, so don't get worked up about a big intraday up move, don't get worked up about a big intraday down move. There's going to be both. While the VIX is as high as it is, on an absolute basis, even though now we are getting to a lower low on volatility, so you're going to expect a jump in volatility to at least a lower high point, right? And then finally, too, when you look at it on a relative basis, it's still up above 1. So we haven't broken 95, much less 90. Once it gets below 90, that's when you have the, now that bullish move has taken hold. We're not there quite yet, and we're still above 1, or at least at 1. So volatility is still going to be high to the upside and the downside until the VIX moderates more. So to summarize, we are bouncing off of extreme lows, and the more extreme they got, the better was for more of a sustained bounce to occur. As the bounce begins, it's not going to be straight up. There's going to be volatility to the upside and the downside, and we expect a good short-term move to the upside, but before the intermediate posture run really takes hold, there's going to be a quick near-term move to the downside to what we'd expect to be a near-term low. So watch for that to occur relatively soon, within the next 3 to 5 days if this near-term line especially gets up above 80 here in the next day or two. So that's kind of what I'm looking at things. What do you think? Do you agree with that or do you disagree with that? Click that poll popping out in the top right corner of your screen. Click that link and then hit the poll. Hit either agree or disagree. If you click disagree, scroll to the bottom of the comments section and type in what you think or what you're seeing that would be different, that would cause you to disagree with what we've summarized here from our market outlook tonight. All right, now let's take a look at what's drove the price action today. You can see it was a U.S.-led rally. Emerging markets really did not. They did pretty decently. You can see small caps were the ones that lagged the most. Safe haven areas, bonds, and gold down. The dollar actually held up relatively well. That's this blue line right here, and of course, crude oil. Started strong, but then finished today after some inventory data with a relatively big loss. You can see commodities down the most, real estate, gold, and long-term bonds were down. That means yields were higher. There's your investment grade bonds. On the other end of the spectrum, you have growth stocks in the S&P 500. There's your international areas doing well. Value stocks underperforming. Small cap stocks underperforming too. So this was a relatively a small move. In fact, someone said today I saw was one of the smallest advancers day on a 1% plus gain that we've ever had in terms of the number of advancers that rallied today. So it kind of gives you an idea. So here we are, fewer advancers. This is breadth. This is the breadth advance decline. This is the number of advancers to the total issues in the New York Stock Exchange. Fewer advancers than what we had yesterday, right, in yesterday's move. But you can see how low it is. Usually you get big moves to the upside. You have big, strong moves of advancers. Like up in this, you can kind of see where the peaks of all these levels rise. And so here is this, and you can see the here's where we're at now, and you can kind of see where some of these days were, these up move days with the advancers. Some of them not so big, right? These moves weren't nearly as big as the one that we saw today, being more than 1% higher. So and you can see that over here when you see small caps and mid caps lagging behind as much as they are large caps. Then it was a very narrow breadth today. When you take a look at the foreign markets, they're all bouncing, and this was all really an oversold technical bounces that we're getting right now. That's the main driver. The biggest foreign markets that's been dropping the most, Argentina. Thailand's been a relative performer lately, and so has Taiwan. There's Russia and the U.S. market. China did okay today too, relatively speaking. All the European ETFs were up, but not up as much. And of course, Mexico has been lagging lately, and so has Italy, of course. And there's Brazil continuing the American continent's relative weakness, and then Turkey. Turkey had a bound down today. You can see if I were to change this, let me get this back to a 3-month return here. Here we go, it's 3-month return. We were just looking at it from that October 3rd peak. Here's your biggest losers are those emerging markets areas over the last 3 months: Mexico, Turkey, India, Italy, the emerging market of Europe, Argentina, Taiwan. Germany is still down 10%, and again the U.S. is still only, with the bounce, only down 3%. So again, a little bit of perspective. I mean, Germany is not an emerging market, and it's down 10% over the last 3 months. Not down 10% over 4 weeks. That's what we had, but down 10% over the last 3 months. That's more of a bear market than dropping 10% in 4 weeks. If we take a look at how the sectors are performing now and how they performed today, let's go to the Let's go to the sector comparison first, and then we'll change the time frame to today. There we go. Go 10 minutes on this. And then we'll come over here, change our list to sectors. Technology and communication services, there's discretionary there. Financials also. I mean, these were all the most beaten up areas. You would expect those to lead the way higher, and they did. Again, the most beaten up areas over the last 3 months are energy, materials, and industrials. There's energy, there's materials, and materials right above the S&P, and there's industrials. They're still lagging. As the dollar still hasn't started to drop yet, they would outperform when the dollar drops. If the dollar still rallies, these are the higher beta, higher momentum names anyway. You would expect them to lead a sharp bounce off of a low point, and you can see a loss for these safe haven areas. Staples, utilities, and real estate. These two at the bottom, more interest rate sensitive, so dropping with the rise in rates today. Again, all just oversold technical bounces. Nothing really more than that. You expect that to continue, but that's out of a lack of news, really significant market moving news. Then technicals hold sway, and again, how so many extreme oversold technical signals, not surprising you'll get an oversold technical bounce as a result. One of the stocks that showed a breakout above 29 before all this mess occurred, renewed a new breakout above 29 again today. Didn't hold at the highs, but the intermediate line getting back above 50, the near-term line getting above 80. You look at it on a long-term basis here. JNPR Networks, you can see back above a rising 50-day moving average, so has a more bullish posture than what you see in some of its peers. We'll take a look at the Bollinger Bands and the volume profile. You can see how important this break above 29 was. There's a lot of volume support at 29, not very much volume resistance up above it. So good opportunity here for JNPR to make some run and you can see the crossover above 25, which is rare to get a crossover of the directional indexes above 25. Again, another good sign for in this case would be a bullish breakout because of the close we've already had. And then finally you look at the 3 green arrows. Let's look at the 2-line version of the 3 green arrow chart. And you can see getting above the 30-day moving average as well as above all these highs. 8-day getting above the 17-day, so MACD's crossed above 0, both above their moving averages. So positive signs. It'd be more positive if these 2 green and red lines get above 30. You expect that they would if we were able to hold these. So you can sell that 29 put. There's some strong support there now that you've broken above that. Buying the 27, we can make sure that this isn't a fake out by waiting for a little bit more of a rally. See, right now your 29 puts at a 45 delta. It's a little high, which means the credit's relatively high, right around 58, 66 at the mid. So all we need on a $2 wide is a 47 cents. Or roughly 50 cents. So you can set a stop limit order to get into this at a 50-cent credit, which means stock has to bounce up a little bit. It has to hold this breakout before this order gets filled. That kind of helps make sure that this move is not a fake out move. When we get right back below 29, it should hold and even move up to through today's high point in order to fill that trade and make that bullish trade. All right, that wraps us up for today. Time to go take the kids out trick-or-treating on a Halloween night. So I hope you all have a fun Halloween evening tonight. Thanks again for watching. Remember to subscribe to our YouTube channel. Click the thumbs up icon down below. That lets us know you want us to keep doing these videos. Comment on anything that stands out to you. Click that link that's popping out that takes you to our forums. You can talk this over with other market scholars over there. Ask questions, comment on, share some things that you're seeing with the community. You can also follow me on Twitter for more content like this throughout the day. I'll tweet out a picture of the kids in the costumes tonight. And also you can join our community that I created, the Market Outlook community we created on Facebook. Again, thanks again for watching. Have a great rest of your evening, everybody. Happy Halloween, and we'll see you tomorrow.